What's up, you guys? Thanks so much for joining me today. It's your boy, the Finance Bro, and in this video, we are going to be taking a look at shares of Mastercard, where shares are trading today, and see if this is a good entry point long term for investors. As always, this video is not investment or financial advice and is solely for entertainment purposes. All values that you'll see within this video are as of market close on May 1st, 2026. Let's dive right in here to the past 12-month price charts of Mastercard relative to the benchmark. You can see that within that time frame, investors have received a negative 9.6% return, comparing that to the 29.2% benchmark return over the same time frame. That does indicate a relative negative performance of negative 38.8%. You can see also shares are underperforming the benchmark on a year-to-date, 1 month, and 1 week basis. And in that bar graph, you can see on the left, shares are actually trading near their 52-week low. And in that chart at the top, you can see shares are still off roughly 20% from their 52-week high. Shares are also trading below the 50-day moving average in the green line there, and the 200-day moving average in the orange line there, which does indicate that shares may be oversold, and the RSI is supporting that as well. Few key items here. I'll touch on the 36 analysts that have a price target of $653.88 in the next snippet. But what's really impressive here is the EPS growth through 26 of 27 of a 15% compounded annual rate, which is phenomenal. And if you look back at the past 5 years, it's quite amazing to see that EPS consistently growing long term. And for such a large company, sales over the past 12 months for Mastercard were 17.1%. But what's even more phenomenal is the profitability metrics, gross margins of 96.6%, a phenomenal gross margin, the best, if not one of the best in the world. You can see that gross to net margin coming down to 45.8%. There's a variety of factors why that is, and I'll touch on it later on in the video with rising rewards and incentive costs, but also Mastercard operates in almost every country in the world, so they are exposed to foreign exchange rates as they report in US dollars, so that will compress margins. As you can see, prior to March of 2026, the US dollar has depreciated relative to most global currencies. So fundamentally, the business is still looking phenomenal. And you can see those valuation metrics there. The trailing PE of 28.7 and the forward PE of 23.9 scream value while the underlying business is growing. Price of sales is a little high, but there is growth in the name. But what I really want to touch on here is the 36 analysts that have an average price target of $653.88. That does imply an average return of 32%. That is phenomenal. What's even more telling is the bull at $735 a share, an almost 50% upside. But the analyst that has, if you can even call this a negative outlook or the most pessimistic outlook relative to the group of 36 analysts, they have a price target of $550, which still implies an 11% upside in the name. What's also more important is you can see those bars in the chart above there. The red does indicate sells. And for the past 8 months, there are no analysts that have a sell rating on Mastercard. In fact, the buys on the name from the analysts are at the largest it's been over the past 12 months, past 3 years, past 5 years, and so forth. What's also very important here is that dotted line that you see in that graph is the analyst price targets on average, and that dark blue line is Mastercard shares. There has never been a point in time where Mastercard shares are trading at such a discount relative to analyst price targets, which does indicate that there is a mispricing in shares as the big money has run its metrics and run its valuations and has determined the true fair value of Mastercard, which is significantly higher than where shares are trading on market close on May 1st, 2026. As we saw, those value metrics in the PE, forward, and trailing are indicating a value name where the business is still growing. In fact, almost all these metrics are trading near their 5 and 10-year lows. So essentially, you've never had a cheaper time to buy Mastercard within the past 5 years and 10 years as well. Quite remarkable. But what's really important here is MasterCard and Visa, they really do make up the bulk of the payment transaction market. But there is American Express and Capital One Financial, which are also phenomenal companies. In fact, Capital One right now is trading at the biggest discount and cheapest valuation relative to the group. But what's even more important is there is a little bit of a discrepancy between valuation metrics and what's happening fundamentally with the company. Now, gross margins, MasterCard has the highest gross margins within the group. It does have the largest international exposure, which is a very high margin business. But you can see that gross margin to net margin compressing for all companies. It is a significant drop for American Express. I want to mention that is because of the high rewards program that it has. And we'll touch on that in the last snippet here. But what's extremely important is the return on assets and return on equity for all these companies is phenomenal, but MasterCard does have the best return. You can see that return on equity of 210.5%. Phenomenal to see that. One of the best allocators of capital for any company, and especially amongst its peers. And what's even more phenomenal is just take a look at this financial statement, guys. Every single metric over the past 10 years is trending up to the right, which is what we want to see. CAGRs on the 5 and 10-year basis, all in double digits. You see those sales and revenue of a 16.5% 5-year compounded annual growth rate, 13% on a 10-year compounded annual growth rate. You're looking at phenomenal numbers. Net income, 20% almost on a 5-year, 14, almost 15% on a 10-year compounded annual growth rate. Earnings per share increasing north of 20% on a recurring basis on a 5-year compound annual growth rate. These are amazing metrics. Every single segment that we're looking at here is a positive for investors, and this is what we want to see. And with all that cash that MasterCard has been accumulating over the past few years, I believe it's important for us to take a look at how they're actually using that cash. And MasterCard is a very prudent allocator of capital. You can see that, especially over the course of 2024 and 2025, that green chart there, that green bar, is the share repurchases, and MasterCard is aggressively repurchasing its shares, especially at such a discount. Management is seeing a discrepancy, just like price targets from the analysts are seeing in share prices. And we want to see that as a boost as shareholders. That does prop up the price by taking out shares on the market. Dividends are continuing to increase over the past few years, so shareholders are actually being rewarded for holding the name. These are two great pieces that we want to see: share repurchases, dividends, and dividends increasing. And what's also important is the debt servicing. We've seen global yields rise and interest rates rise post 2022, and especially this year as well with geopolitical conflicts. MasterCard is servicing that high interest debt, taking that off the balance sheet, which we want to see, while at the same time buying back shares, increasing dividends. So how MasterCard is using their cash has to be, for investors, a sleep well at night strategy. And I do believe that will ironically pay dividends long term for long term shareholders of MasterCard. Now, I do believe it's important for us to take a look at the good and the bad for any company, just so we can get a lay of the land and what risks are actually facing the company, how they can alleviate these risks or manage and mitigate these risks for long-term growth. And right now, what I believe the biggest cloud over MasterCard is the geopolitical conflict in the Middle East. Why this is important is this has caused jet fuel prices to increase significantly, leading to cross-border travel growth plummeting from 8% in Q1 to just around 2% in late April for MasterCard. Since international transactions carry much higher margins than domestic ones, this significantly hits MasterCard more than its peers. And you can see that where Visa, it's MasterCard's closest competitor, does have a 20% discrepancy in its gross margins. And that is just because MasterCard has a better network set up in developing nations as they become more cashless in these tourist areas as well. MasterCard is actually the primary beneficiary. But if you're having these transactions decline because people are traveling less, This does create a significant drag on bottom line for Mastercard and any company within the space. But what I believe is very shocking and telling here is Mastercard's current financial guidance assumes that the conflict ends by Q2, so end of June of 2026. A lot of investors are skeptical about this as a base case, fearing that if the conflict persists past this time, the headwinds to travel and global commerce will drag into the second half of 2026, ultimately leading to a decline in revenue for MasterCard. But what I also believe is very telling here is even though the percentage of transactions may decline, if prices are increasing and there is sticky costs like food and our gas that we need to get to either go to work, see family, see friends, and so forth, those costs are rising. And yet consumers are still going to need to purchase those. So, on an inflationary basis, as that dollar amount increases, even though the percentage amount may stay the same, this provides a sort of inflation hedge to MasterCard's revenue. Also, last year we heard the Trump administration say that they wanted to put a 10% cap on credit card interest rates. Now, this is a midterm year, an election year in the US. So, this was put forth by the Trump administration, does need congressional approval. Let's see what happens there. But obviously, you can see if interest rates are 20 to 30%, that does actually compress margins and revenue for any company, MasterCard in this case. But what I want to mention though is MasterCard is a network and they don't actually set the interest rates, the banks do. The stock still fell because investors worry about what's known as second order effects. I'll use this as an example. If banks are making less money from interest rates, they might tighten credit limits, reducing rewards, and they may spend less on marketing, which drives MasterCard's transactional volumes. So let's see how that affects the company. It is a 1 year cap to begin with, and it still hasn't passed. So let's see if it does pass. And again, this is political brownie points in a midterm election year. Don't believe this will be in effect long term, but let's see. Time will tell. Now, this is quite shocking to me with seeing the incentive costs rise by 23% year over year. That does outpace the growth of the actual payment network that we saw at 17.1% sales growth. This does signal a highly competitive environment where MasterCard has to pay to keep more of its volume. And we see that across the board with Visa and with American Express and Capital One Financial as well, becoming the fourth largest player in the game. It is becoming a more saturated market, a more competitive market, as card holders of these products, we as consumers are the beneficiaries of this increased competition to win more of our business. But as shareholders, this does compress margins significantly. If this remains long term, the benefit for MasterCard, though, is it does have that international segment and other segments I'm going to mention a little bit later on in a few points. And even though we saw cross border travel decline, the US gross dollar volume only grew 4%. And if we compare that to the international segments, that grew 9%. So the international grew more than double the US domestic gross dollar volume. What we really don't want to see that happen is because the US is still the core of MasterCard's business. They are expanding significantly. They are exposing themselves to other currencies, as other financial companies are as well. But when we're having these extreme fluctuations in the foreign exchange markets as well, especially for the past 15 months, you do see that compression. Margins for any company, MasterCard is not insulated to this. So this domestic softening is not something we want to see. That does signal a more cautious American consumer. But again, this usually does happen historically when there are conflicts that a country is part of. Right now, the US in the Middle East. Let's see how that will unfold in the coming quarters of 26 and the first half of 2027. Now, we always hear about SaaS, but no one ever hears or talks about VAS, which is the value added services. I mentioned before that Microsoft was a toll booth. They're no longer just that for credit cards. The value added segment which includes cybersecurity, data analytics, and fraud protection, that's growing much faster than its core business, which is the payment processing. It grew at 18% just this past quarter that Mastercard reported this week, and it now accounts for 40% of total volume. And why this matters is if these services are continuing to grow, they're high margin businesses and they're less dependent on how much people spend, which does provide a cushion during economic slowdowns like we saw with the US gross dollar domestic volume decreasing over the past quarter. Mastercard, ironically, is no longer just that fintech company, it is leaning more into that tech company through its AI services. The company recently enabled nearly all MasterCards for Agent Pay, which allows AI agents, kind of like your personal digital assistant, to securely book travel, order groceries, and other services, and could do this with what's known as verifiable intent. Quite remarkable there. And in March of 2026, MasterCard launched the Agent Suite, which helps businesses build their own AI agents, keeping MasterCard at the center of the next tech revolution. Quite remarkable. They're the only payment processor that is doing this. And as well, we always see a growth of how money is used as a medium of exchange. We went from cash to having bank accounts, which is now a digital form of your money. And now we're having cryptocurrencies and tokenization taking forward humanity in its next evolution of how we use money as a medium of exchange. And the planned $1.8 billion acquisition of stablecoin infrastructure provider BVNK signals that MasterCard wants to dominate the movement to digital currencies across borders. This is what we want to see. And by replacing card numbers with secure tokens, MasterCard is significantly reducing fraud and making digital wallet payments more seamless for its users. In fact, this grew 56% for some partners just in its most recent quarter. That is phenomenal. They are investing cash in the right areas, and we saw that with the return on assets and invested capital. MasterCard is the best allocator of that. And we're also seeing a lot of shareholder friendly initiatives being done with share repurchases and share dividends increasing over the past 5 years. As always, guys, thanks so much for making it to the end of the video. Please do hit that like and subscribe button. Just want to present to you guys some facts for MasterCard. I believe this is a sleeper pick here. Again, not investment or financial advice. Please do hit that like and subscribe button and stay tuned for the next video.